What's Making Headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hello and welcome back to What's Making Headlines. It's Annie, Ben and Charlie with you today, unpacking the big news of the week. Good week, Ben?
Yeah, it's a good week. Very busy. It feels like stuff's really swinging into gear again.
Yeah.
I think I say this every week, though.
I think every February we're like, whoa, what a month, because everyone catches up from the break. But yeah, and I think getting into the year ahead, there's been all these appointment changes. There's all the results coming out. There's all the mergers and acquisitions going on. There's a huge amount of activity. So I've been pretty busy this week. Charlie, you've been doing a lot of news writing as well, furiously typing away for all of the results this week, which we'll unpack a little bit.
I have, yeah. It's been a good week, fast paced and fast moving, as you both said. Both results half yearly coming in and keeping us on our toes. Those four major banks, never letting us lie. But yeah, lots of interesting things to unpack.
Yeah.
So.
Oh, the other thing I've been laughing about this week is that because it's Valentine's Day tomorrow, the amount of press releases and pictures we get about love-related angles, you know, finances and financial heartbreak and, you know, couples feeling like their kind of, you know, dreams have been smattered because of their love goals. Is just, very
It's been a long crawl too. I've been receiving those for the past 2 weeks.
Yes.
There's also the romance scams and that kind of thing.
The romance scams, warnings about those. And Mortgage Choice has some data out as well, talking about like people saying they don't think it's feasible now to buy a house unless you're in a couple. So maybe this Valentine's Day, people just on the prowl for a couple, another partner just to buy a house with. You know?
I don't blame them.
On a mortgage.
Should we share some income? Yeah. So romantic. Anyway, but the big news this week that happened this morning was the news that Peter White, the managing director of the Finance Brokers Association of Australasia, is stepping down from his position. Huge news for the industry. Peter's been in the mortgage and finance broking industry for about 40 years, one of the pioneers of broking. You know, I think he was the first CEO of Wizard Home Loans. He was a finance broker himself.
Yep.
And he's obviously done a huge amount of work with the association over the years as well. You know, he's been a lobbyist. He's talked to regulators. He's talked to politicians. He's represented the industry all the way through big, you know, changes across the board, whether that was the Royal Commission, whether it's regulatory things, payroll taxes, talked about lots. So huge news this morning. And I'm just going to cover off some of his highlights of his career almost.
Yep.
We should say, actually, sorry, when he announced that he was stepping down, retiring from the association, I think they are currently working on finding a successor, so there'll be a handover process. But he did say, I've met countless lifelong friends and I've had the privilege of being part of the tremendous growth and impact of the FBAA. Today, our association is a leading voice for our sector, respected by those at the highest levels of government and industry, and sought by national media for commentary due to our credibility and expertise. He said that change is not only good, but necessary for any organisation as it brings new ideas and fresh vision. So I think, like, you know, when you've been at the top for a long time, I guess he's kind of felt like he's achieved all he wanted to, and now's the time to step back. But I think both of you have talked to Peter in the past. He's always been a great supporter of the broking industry and the broker media on the Advisor and Broker Daily here at Momentum. So, yeah, we're going to miss his punchy commentary and his quick responses.
Yeah, I mean, I've only really been covering this industry for a couple of years, but he's been one of the sort of ubiquitous figures that you sort of always hear from. He's always been really generous with his time whenever I've talked to him, and he's always really good for a comment and a quote and that kind of thing.
Yeah.
So, it'll be strange sort of, seeing the industry
moving on with a new FBAA head.
Yeah, same with me. I've obviously been here for a much shorter amount of time, coming up on a month. Not sure how that happened. But yeah, even in that short amount of time, he's been very prominent and prolific in his responses. I know we've been writing about ASIC a lot and enforcements and they're kind of clamping down on ads. And his comments on that really stuck out to me quite early on on the onset.
Yeah.
Just having brokers' kind of best interests at heart and not beating around the bush.
Yeah, and
with
of course,
his comments.
the FBAA is an organisation, a body as a whole, so it's the whole of the association doing a lot of work. But he's really been at the forefront and kind of like the spokesperson for it. And he did actually thank the many who've served on its board, the state teams, staff, and the thousands of brokers across the nation who support the association. I think they have about 14,000 members. So I'm sure there'll be lots of people today reaching out to Peter. I'm sure his phone is blowing up, just like all the texts and calls he'll be getting and well wishes from people in the industry. But yeah, an end of an era. And as I said, I'm just going to go through some of his kind of the career highlights, if you would. It was quite fun writing the story to look back at what he's been doing and all the millions of stories we've written with him in it. But yeah, he's been at the association since 2003. He started as a volunteer.
Wow.
Before that, obviously, he was in, as I said earlier, the first CEO of Wizard Home Loans. He also established the first branch of Rams Home Loans back in the day. He's worked in broking and finance broking. He's been a lobbyist, and he's also worked in banking and private banking. We know, as we've said already, he's done a lot of work over the years with the regulators and representing the industry.
Yep.
He's been on the FBAA board since 2016 and held a range of different positions over that time. When I was looking back at his sort of potted CV, it was a bit like he's currently managing director, but he's also been national president. He's been CEO. He's been state head of state, I think, as well for Queensland. So he's had a lot of different roles, senior roles at the FBAA, as well as starting off as a volunteer. He's worked with loads of different of the forums as well. He's been part of the Commercial Asset and Motor Forum, Concierge Advisory Forum, Equity Release Advisory Forum. And as we said, done a huge amount of work over the years for changing the shape of what broking looks like, really. So lots of things going on there. He also helped set up the International Mortgage Brokers Federation. So he is the inaugural chair of that association, which is basically broker associations across different countries. And he got an OAM in 2019 in the Queen's Birthday Honours List for outstanding achievement and merit in services to the finance sector for over 41 years.
Not a bad CV.
I'd be pretty proud of that. Pretty chuffed about that.
Oh, yeah.
But yeah, so really, I think lots of work going on there that he's been spearheading. And I think, obviously, being with the industry association for so long as well, probably they're just thinking, you know what, I've done everything I need to. I've gotten through a lot of this regulatory change. You know, he was there for when Best Interest came in. He was there for when NCCP came in. So yeah, he's probably just wanting a well-earned rest now.
Calling time.
Yeah.
And it's really important for industries to sort of have those figureheads and people advocates who can sort of represent views and that kind of thing.
Yeah.
Particularly whenever there's regulation or government sort of things going on. So, I think he's been hugely important for the industry. But he's also done a lot of stuff about awareness for mental health issues and wellness and that kind of thing. So
that's true. Yeah, he helped set up the the FBAA did. They set the wellness hub that they have for members. He's talked a lot about his own mental health struggles in the past. He also has done quite a bit for charity. He set up the Sanity Foundation, which supports parents of children with special needs, as he had a child with special needs, has a child with special needs. So I think, it's doing a lot to kind of support people as well, which is really lovely. And we've already started seeing the comments coming in on our socials and on the story about people thinking about their interactions with him and how they kind of, want to wish him well on his future. So looking forward to seeing how the FBAA, moves forward from here, because they've got a new chairperson as well. They've, I think, appointed several new board members last year, which we covered on The Advisor. So it's generally a kind of period of change and rejuvenation and maybe looking at coming up with new ideas. So I think whenever there's kind of, one door closes, another door opens, as they say.
Yep.
So whenever there is changing of the guard, it's always interesting to see, well, what happens next, and I think this is what Brett Spencer was saying. He said, he's the chairman, of the FBAA, was saying it's a difficult decision for all, but the time is right for him and the FBAA. And he said, Peter's been a general for this association for over 20 years, and like all retiring leaders, he'll be missed by many. And he, again, hailed the success of his long tenure and said that the association would continue to build on his legacy. So, huge news story today.
Very much so.
And I think our website actually crashed because of the traffic. So, Thank you for everyone for your patience. But looking at how much he's been sort of, giving back over the years, well done, Peter.
Yeah.
Thank you.
Just
for your
shows how much
service.
of a massive figure he was as well. The website crashing within a matter of hours. Really.
Yeah, within 20 minutes.
Well,
I think,
there you go.
Yeah, it's back up now. So
It's back up now.
Yeah.
You can read the full story. But yes, that was massive news. And I think, as we say, we're really looking forward to hearing more. I think members will obviously be getting lots of updates from the association themselves. So we look forward to hearing more from the association as they look for a successor and what that looks like. You know, whether it would be one of those old positions, you know, is it a CEO, an MD, or national president? Like, what does the next leader look like? But of course, as we said, the board is still there. There's all the state managers and the volunteers at the FBAA still there. So no real change for now. But that was a big way of starting the weekend coming up.
Yep.
Cool. We do have lots of other things we've been writing about this week. Our normal run of things, including financial results, including lots of mergers and acquisitions still coming through. And we'll get into that just after this. So keeping on the kind of regulatory and governance sort of angle, this week we actually had some feedback from a broker over in WA, Paula Parola, who said, finally, the Treasury has responded to the petition she started about clawbacks. Charlie, you wrote the original story, but you wrote the follow-up.
18 months later.
18 months later, she gets a response. So if people haven't been following the story, you might not know that Paula Parola, who, as I said, is a broker over in WA, started a petition on the Federal Parliament website calling for clawbacks to be scrapped. So basically, her argument is, when best interest duty came in 2021, brokers had this new obligation to their clients. And she's saying, but the fact that we still get clawed back, particularly, the commission still gets clawed back, particularly for instances where it's out of a broker's control. She's like, this surely is not right. And we're the only real industry that has a very high kind of regulatory burden, but then can also have our income stripped back away from us. So she's saying, it's not fair. And was saying not only should the government strip clawback commissions, but they should also refund commissions that have been clawed back since the best interest duty came into being. Now, I think that one might have been a step too far potentially for the government, but taken them 18 months to come up with a response, which I think is pretty interesting. How did that what did they say? What were they talking about in the response? It was Treasurer Jim Chalmers.
Yeah, it was Chalmers. It was Federal Treasurer Jim Chalmers who presented his response to the Standing Committee on Petitions on
the 9th.
Dated the 4th of November, but it was the 9th of February that it was read, and it was a pretty subdued response. But all in all, he rebuffed it and basically said it comes with too much complexities, and we can't commit to anything sweeping or abrupt, like you introed that cancelling and refunding clawbacks, and he said that. His quotes to the committee were, broker commissions are ultimately a commercial matter between brokers and lenders and subject to the existing regulatory framework. The government does not prescribe situations in which such arrangements should be entered into. And he further stated that clawback arrangements with each credit provider may vary and have adapted over time. And he basically concluded that the government notes that the petition requests to remove clawbacks and refund those charges, and that while they understood that some brokers felt the arrangement no longer reflected the reality, the implementing a prohibition on clawbacks or retroactive funds on clawbacks raises complexities, were his direct quotes on that. So
it's too hard.
Yeah, he's put it in the too hard basket, and he's basically gone, it could undermine deterrence and create industry confusion and destabilize existing regular expectations. He's listed off all these things that it could have flow-on effects. They want to, if they are to amend anything, it needs to be, or reform anything, it needs to be minor and gradual.
Yeah, and I think what they've said a lot in the past as well has been like, this is a commercial contract between brokers, well, actually between aggregators and lenders. So he's like, we don't interfere in commercial matters. But I think the broking industry's point, and a lot of brokers who signed the petition, I think there were like 2,000 people who'd signed the petition, were like, this is a major problem because it's actually anti-competitive. Because if we're being pulled, our income is being pulled back from us, 2 years later in some cases, that is not feasible. Like, it's the only kind of like case of, that I can think of at least, where an industry does some work and then 2 years later, they get their income pulled back from them. So
Slapped away, yeah.
Yeah, so I know that lots of lenders over the last couple of years have been changing their clawback structures. So we saw a few of them, I think in 2024, a lot of the lenders moved to sort of pro rata basis. So normally it was like if it's sort of if the loan refinances away from that lender within the first year, then it might be 100% and then it kind of staggers down. So a lot of them kind of go down to 50% within 18 months.
Yeah.
Which I think brokers were welcoming. And obviously the associations, both the FBAA and the FBAA, doing a lot of engagement with lenders and regulators on this.
Yep.
So that's definitely a step in the right direction. I think
sure.
a lot of brokers were very pleased to see that because particularly when we had all that refinancing boom, when rates were coming down in 2020, 2021, a lot of brokers then were like, well, my client just moved without telling me and now I've had my commission clawed back. It was a huge amount of money being clawed back from brokers because of all the movement. And then obviously last year we had 3 rate cuts. So again, I think a lot of brokers were seeing their commissions clawed back as well. And they've gotten a lot better, I think, with being more proactive and hiring staff now just to look after their back book and ensure that their clients are happy. But if you've got a huge black book, that's kind of hard to do if you've got more than 1,000 clients.
The broker who submitted the petition pointed that out as well, that it's really hard to factor that in. It's hard to plan for. Oftentimes it's unexpected. Cash flow, it can kind of come out of nowhere and have a massive impact on certainly small to medium sized brokerages and firms as well. So it's definitely a valid concern. And the Treasurer wasn't outright in placing the issue, amending clawbacks in the too hard basket. Kind of said, well, look, the government's open to nuanced reform and a fact-based review moving forward. So, but they kind of always use this ambiguous language when they're responding to things like this.
And I think, again, like when clawbacks were put in place, it really was as a sort of measure, at least as far as I understand it, it was put in as a measure to stop people churning through their books. So not to, they didn't want brokers putting a client with a lender and then 2 months later moving them somewhere else. So the lenders were like, we want you to ensure they're staying, that they're happy, and that you're not just kind of jumping them around. So we'll claw back commission if you do move them away. But I totally understand from a perspective of where it's outside the broker's control, whether that's they've sold the house, they've divorced, maybe they've died. Like if a loan comes off a bank's book within 18 months or 2 years, like because someone's died, like surely why would you penalise the broker for that? Like they have nothing to do with that.
No, I feel like there need to be caveats.
Yeah, there should be
to
caveats,
the
particularly for the ones that are outside their control.
It shouldn't just be outright. Like you said, there are...
Or if they got divorced and they separated, they sold the house.
Exactly, extreme circumstances that a broker doesn't really control.
But I guess like all the lenders sort of vary with their approach to clawbacks, right? And it is a sort of commercial arrangement.
It's a commercial arrangement, which is why I think the Treasury's been hesitant in the past to intervene. But, non-banks, lots of non-banks have no clawback policies. So lots of brokers really love them for that. And we have, as I said already, the banks have been already tailoring those and trying to make them more fair for brokers. And we did see a lot of the majors 2 years ago move their policies to be a little bit more equitable. And again, as we said, that's partly because of the amount of work that's been going on in the industry to try and get that. I think also just talking about best interest duty that we briefly touched on here, there was quite an interesting webinar this week that the MFAA held, the Mortgage and Finance Association of Australia, on best interest duty from ASIC. So we know that ASIC's been going through the first really real audit of compliance with BID. Because normally they tend to do this 5 years after legislation's been brought in. So they've just started doing it. And MFAA had ASIC on their webinar. Fascinating to hear from the horse's mouth what they've been doing.
Very much so.
What have they been doing?
So the first real update we've had from ASIC about this ongoing information fact-finding mission to review the BID and BID compliance with brokers' BID compliance. And it was Nathan Bourne, Senior Executive Leader for Credit Banking General Insurance at ASIC. And he basically went through quite methodically the process, how they've been conducting this. And he first kind of pointed out how they've been gathering the data.
So they're going to aggregators and being like, give us your files?
So they sent notices to 6 aggregators when they announced the review in June 2025, but he kind of went into more detail about that and said to reduce the workload of the participants, because there's obviously a lot of data here to send through. They sent them data dictionaries, which were like specific kind of points that ASIC wanted to receive, misconduct, breach notifications, complaint data from the Australian Financial Complaints Authority, things like that, to kind of identify gaps and build a bit of a baseline as to what's going on, re-compliance. And then after they did that, he kind of went into the 4 major areas where ASIC is going to focus on this compliance review, which is, firstly, they were examining product recommendations. So brokers needing to have clear, explicit files as to why they recommended a product and the rationale behind it, especially if it was a more expensive product. He emphasized that a lot throughout his speech. And also monitoring programs from aggregators as well, and supervising products and loans that were offered and why as well. And also complaint handling and the collection on remuneration structures and examining potential conflicts of interest as well.
I think that's why they're looking quite closely at how brokers are recommending loans that have a higher interest rate or might have another thing that they think could potentially be a conflict. They're being like, how are you justifying this? But I mean, rate is obviously a major part of how a lender, a borrower thinks of their mortgage, like, or their loan at some point. But a lot of the time, it's not actually just that. It might be the product features. So, they might be willing to pay slightly more if you get an offset account, for example. Yep. It might be that if it's a business loan, they're going to be looking at something else. Obviously, non-NCCP doesn't cover, you don't have the bid coverage at the same time. Yep. But for mortgage brokers, I think rate, of course, is a leading factor. But for many people, they want many other things. So I think it's basically saying if it is a loan that has a higher interest rate or it has higher costs, you need to be super clear on why you recommended that or why the client has taken it in your notes. So just making sure that note taking is clear. So, so there's no kind of argument if they think, oh, well, maybe you've pushed them into something because you might get a higher commission.
No. And when prompted by the MFAA as to what it expected to kind of recommend in the review, one of the clearest points that he made was brokers needing strong data documentation, explaining their choices, particularly when suggesting higher cost options. And he kind of pressed that these were, like I was talking to Ben about during the week, we had a good discussion about it as to, these can be really stressful decisions for households as well, often households who are under strain and under pressure as well. And he said that. So brokers needing to have records demonstrating were there alternatives recommended, and did the client have a opportunity to review those alternatives as well.
Because I think that's right, isn't it? Like if you do get challenged, so if there is a complaint made to AFCA, it can be you don't want it to be he said, she said. You kind of want it to be, here's the proof of the outline of what exactly happened.
Of
course, you'll have so many clients who will be able to remember everything, but being able to have some real evidence to show why you've done it can help you in a lot of circumstances.
Is that kind of documentation practice sort of standard practice in the industry yet, or is that something brokers are going to have to think about a bit more?
I think when the best interest duty came in, the aggregators did a massive amount of work on their CRMs, making sure that the broker processes were really clear on making notes. And so this has definitely been something that everyone's been working on. ASIC did actually release a guide as well for the best interest duty when it first came out. Actually, not when it first came out, quite a while after it came out. So I think that has been really helpful, and the aggregators and the associations have obviously been really clear on making sure that those things have been delivered. But I think as we sort of say, it can be that maybe 5 years later people might not have read the guidance recently. So just reiterating the point of being like, make sure your broker notes are clear. And I think again that's why lots of brokers had hired admin staff. The last few years we've seen lots of brokers have not just one support person, but in some cases 2, 3, 4, 5. And a lot of that is to do this paperwork, to do the admin, to do the compliance checks, to make sure that all the boxes were ticked and all the notes are clear. So,
I mean, my uncle's a mortgage broker, and in recent years, he's operating a business for about 15 years. But in recent years, he's expanded his staff, mainly because all of that regulatory needs have kind of built up over time, and he can't handle it on his own. He needs people to do it for him. And Nathan Bourne basically said in conclusion that, quote, record keeping and the recommendations and why the recommendations are being made is quite paramount.
Yeah.
Those are his words. So, and he kind of said, look, when pressed on what the result of this review would look like, he said, well, we don't know yet. We only received the majority of this data before Christmas, so it could be a media release,
while.
it could be a short form document, it could be a lengthy document with explicit recommendations that he said obviously the regulator would supply to chief aggregators and
really
brokerages
hope
alike.
It's not just a media release. After all of this work,
I
we want
hope
more
not.
detail than
Yeah,
that.
I saw the MFAA policy and legal chief who was conducting the interview kind of squinted when he said media release. Surely,
Like, give us some more detail.
A review that's been going on will likely be a year deserves a little bit more than a simple 500-word media release.
Yeah. And I think the main thing is basically if they find bad practice, fixing it. So I think it sounds like they're not really necessarily chasing enforcement.
No.
They're just checking compliance.
Yeah.
And if there is non-compliance, stamping that out very quickly by being clearer with what they expect. So I think it sounded relatively positive. Although, of course, he did say, I think, we may need to take enforcement action if the case may be, if people are breaching the law, of course, as you would expect. But yeah, hopefully you don't have to see too many of those things. But I think this has been feeding into, as well as we talked about recently, the increased asset costs for 2025. FY25 has been the bid review, maybe.
Yep.
Because we were trying to say last week, I think it was, why have the levies gone up so much from the original estimates? Perhaps this is fed into it.
Could be. Yeah, it could be. This was a clear indication of what ASIC's doing behind the scenes. So it was a good update and good to hear the work that they're doing on this ongoing.
That was a pretty
review.
lengthy webinar as well, wasn't it? Because it was not just ASIC. They also had a broker panel.
They had Claire O'Neill speak. They had a couple of economists speak as well. So yeah, it was a jam-packed day. There was some technical issues at the start of the webinar, but I think that was just because there was so many brokers tuning in, and the chat forum was just flooded with.
I feel the pain.
I want to watch my webinar.
I know.
So lots of people were keen. There were a lot of keen watchers there.
High traffic, server problems. I feel their pain. We're going to take a quick break here. When we come back, we'll be chatting about yet another broker acquisition that was announced this week, plus some of the results from the financial results season, and we'll get into that just after this. So earlier this week, we had another acquisition of a brokerage. And as we said, I think last week or the week before, this must be number 6 in the last 5 or 6 weeks that we've had announced. And this is REA Group buying a commercial brokerage. Super interesting seeing REA Group, which people may know owns Mortgage Choice, and they have financial services arms, and as well as all of their property platforms.
Yep.
Basically taking a 70% stake in the commercial finance brokerage Simplicity Loans and Advisory, which also operates Marketplace Finance, which is kind of like a referral platform. And this is a huge deal. So Simplicity is a Sydney-based commercial brokerage. So it's headed up by Jean-Pierre Gaussin and Matthew Johnson. And we've actually done podcasts with them both in the past, talking about how they run Simplicity. They're a top 25 brokerage in the country as well, do a huge amount of volume with actually quite a few, not that many brokers. I think they have like 12 brokers according to the top 25 brokerages ranking, but they do a huge volume and really focusing on commercial property transactions and secured lending, but mostly commercial property. So REA taking a stake for an undisclosed sum. We're always keen to know how much the deal is worth. Hopefully we'll see that at the end of the financial year results. It will be in the pack, hopefully. So they're taking a 70% stake in Simplicity Loans and Advisory with the option, well, actually not the option. I think they are acquiring the remaining 30% in 2029. So they've got a few years to bed down before they buy the rest of it. So it will be outrightly owned by REA by the end of this decade, but for now 70% owned. And Simplicity pretty much will continue on as its own brand, as its own brokerage. Pretty much, I think, from what I was hearing from Jean-Pierre, will be business as usual, just with a different owner. So they're continuing to write their own loans. They're continuing to service loans referred in through Marketplace Finance. And I think this sounds like, to me, that's what has been the most interesting part for REA, is that Mortgage Choice, which is the brokerage brand, another top 25 brokerage in the country, had traditionally been mostly resi. So I think while Mortgage Choice brokers might do some commercial lending, I don't think Mortgage Choice has too many commercial lenders on its panel. It's not really focused on that area. It's really focused, as the name would suggest, Mortgage Choice, on resi mortgages. So I think this is a great way that they're saying, well, we want to be able to offer our clients commercial loans. We might not have the specialist brokers in the group already writing commercial loans. We might not have the commercial lenders potentially as well on panel. So by acquiring the commercial brokerage, they can refer out commercial deals to Simplicity and they will write them.
Yeah.
Kind of win-win.
Yeah, when you sort of frame it that way, you can sort of see why they're sort of pursuing this move, I suppose. It makes a lot of sense for both parties.
Yeah.
For sure.
The thing that interested me though as well, because when it happened, I was like, well, does that mean that Simplicity becomes a Mortgage Choice brokerage? But no, they're staying with their current aggregators. I think they have both AFG and LMG, but will just be owned by REA Group. So I thought that was really interesting. We very rarely see brokerages acquired by a group that has a stake in an aggregator arm or a brokerage arm without making them come over. So you might remember AFG recently acquired, can't remember who it was. AFG recently acquired a brokerage and they weren't with them, but they came over to AFG. So I think, interesting to see them actually staying with their current aggregators. That is going to be a nightmare trying to figure out all that admin and systems and things of being like, what's coming from where?
Yeah, but you can see the synergies, like probably mortgage, how many times ever would a Mortgage Choice broker have been offered a commercial opportunity that they've had to refer somewhere else, refer out, whereas they can sort of keep it in-house in a way now.
Yeah, and I imagine quite a lot of Mortgage Choice brokers will already have, as you said, referral partnerships. I don't think they're forcing them to use Marketplace Finance or Simplicity to write these deals, but I think it's basically saying we're giving them the option. I'll just read what the CEO of Financial Services and Mortgage Choice, Anthony Waldron, said. So he said, the volume of commercial loans settled by brokers in Australia has increased significantly in recent years. By extending beyond residential lending into the fast-growing commercial lending market, we will accelerate our commercial finance strategy while adding new capabilities and revenue streams. Simplicity is a great business and has achieved impressive organic growth. We see significant opportunities for integration and future growth by connecting Simplicity with Mortgage Choice and more broadly across the group. And then he went on to say that basically it will create lots of opportunities for Mortgage Choice brokers and strengthen the group's ability to offer tailored service across both resi and commercial. I actually think Anthony Waldron and Jean-Pierre Gaultin used to work together when they were at NAB. So they already know each other fairly well. So I think that probably also helps when you're acquiring a brokerage to
personal relationship.
Yeah, have a personal relationship already and being like, show me everything under the hood and kind of trust that person. So yeah, really interesting to see that. And I wonder if that means that JP and Matthew will take a little bit of a holiday. I would.
Yeah.
Good opportunity.
I think they still
it.
probably have to service all these loans now, but
sure.
I would still take a little bit of a break, you know. I'm not sure if it's actually settled yet. Let's see if they said when it will complete. I think it might have already completed. It's subject still to regulatory approval, so it's completed in 2 months.
Yeah.
What does that take us to? April.
Yeah.
There we go. So that was pretty exciting. And as we said, you know, another acquisition in the space. We continue to talk about this. 2026 being the year of acquisition. So many of the big brokerages really consolidating or snapping up other brands.
We're so early on as well. It's
still very early on,
1.5 months, really.
Lots of the top 25 brokerages, which were announced this year, have been purchasing other broking brands or merging in other broking brands and getting bigger and bigger and bigger. So pretty exciting. I think by the end of the year, we'll have a pretty different landscape, which,
Seems like it if the trend consists. That's for sure.
Talking about what else we've been seeing though, results season, we mentioned this. Lots of different lenders, depending on their financial calendar, either doing quarterly updates or half-yearly updates, or in some cases full-year results.
Yep.
The big one from you, Charlie, this week was Australia's largest lender, CBA, releasing its half-year?
Half-year.
Yeah.
26
what
half-year.
Did they tell you in the results?
So...
It was a big pack. It was like 100 and something slides.
It was. Yeah, it was a little bit intimidating, but it was a very good learning curve. And myself and Julian on Broker Daily had a great time taking this on. Me on kind of owner-occupier and him on business loans and whatnot. So
and of course, the big question, broker share.
Yeah, broker share. So the big story to come out of this was that proprietary channels direct channels at CBA have basically held consistent at about a third, 67%.
2/3.
2/3, yes. 2/3, 67% of CBA branded home loans, excluding subsidiaries, are now coming through the proprietary channel.
Yeah.
So that was the big story for us on the advisor out of these results.
Because we know that from a few years back, they were saying they were focusing a lot of their attention on proprietary and trying to build their net interest margin. Because apparently, supposedly, although we haven't seen the calculations, they're saying that broker channel loans are 20 to 30% more expensive.
Yeah, they slipped this one in.
They always do.
They do.
We're always like...
For context,
Sure.
I did read their last year results, and it was the same exact statement. So they did emphasize that profitability, not cost. Okay. Lay at the heart of the shift. And they claim that proprietary loans yield 20 to 30% more than broker equivalents on a $600,000 average. Once all those upfront commissions and trailing book payments and whatnot are factored in. So that's one that's going to ruffle some feathers. I know that I spoke with Ben about the language and phrasing on that and with you as well as to where to get that from. But they were pressed on this in the Q&A session as well. And in the kind of executive summary, their CAO, Alan Doherty, basically said, his words were, home lending, we continue to prioritise and grow proprietary distribution with $55 billion of new fundings originated over the last 6 months through our own channels. It's huge. A lot.
It's huge.
Massive amount. And then later on, when shareholders were given the opportunity to ask CEO Matt Comyn and Alan some questions, Richard, a CBA shareholder, pointed the fact that, it's a consistent trend across the major banks that CBA and their competitors are all similarly growing proprietary channels. And he basically...
Wonder if he read that on the advisor.
I hope so. I hope he did. And he asked Matt Comyn directly if he expected proprietary channels to continue to expand and that trend to keep on going. Premised on the belief that it wouldn't lose any of its existing share of third-party broker portions if that would fall as a result. And Matt Comyn was quite careful in the way that he answered this, and he basically said, "Well, look, we face a lot of different choices," and emphasised that brokers are really important for the bank moving forwards. But he did acknowledge that proprietary distribution, quote, has been a strength for some time. And the team have executed that really well. We have 55% of proprietary mortgage origination, and the other banks are joining and having a greater focus on that. So
they're all chasing that interest
absolutely,
margin.
Yeah. There's no secret about it that's the path that they're all heading down, and CBA is quite unashamed about it.
Well, I mean, and they shouldn't have to be. And good. It's nice that he recognised still the contribution of the broker channel, but as you say, a third now coming from broker channel, at least in the half.
They now make up 33% of the 83 billion total CBA branded mortgages over the last 6 months.
And then of course, if you factor in Bank West, which has kind of been the predominantly broker channel since it's moved to a digital bank and they've shut branches like that, we expect to see that broker flow increasing over time, and I think it has increased as well over the half. So I think when you kind of look just at CBA, CBA as well, the main thing that people always love that go to them is the app. So you can't turn around and talk to a CBA customer without them talking about the app. They love the app. So I think it just makes sense. Like so if you're in the app all the time, you get served an advert for a home loan. It makes sense that people are choosing to do that. They don't want to move their bank accounts if they've already got a CBA bank account. And we know that lots of people do. Biggest deposit holder in the country. So kind of like, sure. That makes sense to continue pushing that. But it is great to see that he's also saying, but, we still support the broker channel. We're still working very strongly with the broker channel. Brokers still really like using CBA.
Very much so.
Really high uptake still, one of the most regularly used lenders. Even though they're focusing most on proprietary. So it's good to see that it's not really impacting people's judgment too much, although we do always hear comments from brokers saying, I'm refusing to use them if they're not going to be focusing on proprietary. So it depends on, I guess, your attitudes and what your clients want.
It does cause a lot of tension. I know I've had frank conversations with my uncle about this, who mainly deals with and lends out to the major banks and the top 10 banks as well. Those are his preference. He's a mortgage broker. And this always riles him up that CBA is shifting their priorities, even though when you include Bankwest, it's 46% of coming through broker channels. So, like,
is that the overall portfolio?
Including Bankwest.
Just new business or overall?
New business.
Yeah.
New business. So again, it lifts once you include their kind of broker arm, which is Bankwest. But still, obviously, mortgage brokers out there that have a lot of business with the major banks and their top 10 competitors. This is a point of tension for them, you know. But like you said, these are banks that have got a massive front-facing, you know, nature. They're expanding their digital arms. They've got branches everywhere. It makes sense as to why they would be kind of offering and prioritizing their own direct products as well.
Yeah, but we know, I mean, what did you say, 55 bill just for CBA?
Yeah.
That is massive. And we know that lending has been huge. We had ABS lending statistics come out this week as well, and that was again saying near record highs. The average residential mortgage value going up to, I think, a record high. Huge amount of activity from investors, huge amount of activity from first home buyers, partly driven by government guarantees. So across the board, 2025 was massive. So it doesn't surprise me that for the results ending December 2025, we're seeing that from the lenders. No. And the outlier, though, I suppose, from the results this week that we looked at was AMP. We know last year their loan book went backwards. So they shrank. Yep. And this was all part of a deliberate strategy. They were basically like, we're not chasing volume. We're not going after it. They've been redoing a lot of their things. So they launched a new broker portal last year. They launched a new lodgement system. They've got AMP Bank Go, their digital bank, launching as well last year. So they had a lot of focus on kind of transforming almost. So they were like, we're just not chasing volume. So they really pulled back. We saw that in their FY24 results, where their bank book went backwards. It grew this year, but it's still below where it was before it started declining. So I think it's about 24 billion. Is that right? Let me double check.
The residential mortgage book grew 3.8% to 23.9 billion, up from 23 billion.
24 billion, basically. Billion, so I think, like, looking at that, I mean, it's
quite incremental.
Yeah, but what was interesting was, even though, you know, and I spoke to Alexis George, the outgoing CEO of AMP Bank, about their results. This is for the full year because they're on a different financial calendar than everyone else.
Yeah.
She was saying, you know, we're obviously pleased with the growth, but she was like, it's not huge because it's still below where we are in FY23. She did also reflect that it's 0.6 times system. So she's like, it's pretty flat. But it's all about careful margin management strategy. So she's like, we've done this on purpose and we do expect to grow. But they've also been really pivoting AMP recently to kind of being this pre-retiree brand. Yep. It's always kind of been that, but they've really been really focused hard on it this year in FY25, in their FY25 ending December. So looking at, you know, as I said, launching new products. So really focusing on that segment. So they had the 10-year interest-only loan release. They had the SMSF loan increase. They were the first now bank to step back into SMSF with an offset, which we talked about last week before?
A couple of weeks ago.
Yeah. So, and unveiling the new broker platform, which apparently has been super popular. And actually, they've seen their broker market share increase, which is incredible considering they had 94% broker flows. Now they have 95%. So, I mean, brokers. Wow. I mean, they don't really have branches. So majority is through broker. I think there might be some through other kind of advisors, but a majority coming through the broker channel. So seeing partly, Alexis George was saying, partly it might be because of our new portal. It makes it easier and faster for brokers to users. So she's saying, you know, it's certainly being well received. We're getting quite good feedback on the timeliness and actually making sure applications are complete. So it's certainly one reason for the broker growth. She did also touch on the fact they've been focusing a lot on AMP Bank Go, which is currently just offering, I think it has overdrafts, but the rest is sort of savings accounts and deposits. And she was saying that's been going really great since they launched in February 2025, and their funding has increased dramatically. And that's all about building deposits so they can continue to fund at a competitive price, basically. So diversifying their funding stream. So by having this digital bank, AMP Bank Go, by having more deposits come through, I think there was something like 300 mil in deposits from AMP Bank Go. Did I take it out? Maybe I
Yeah,
took it
you're
out.
right. $310 million in deposits with a long-term target of $1 billion.
Thank you. I was looking for that stat. I was like, is that right? I might have made that up.
I read it, but you wrote it.
Yeah, I wrote it. Couldn't remember the statistic off the top of my head. But yeah, so really interesting seeing how that's been growing, and that's pretty good growth for less than a year, or just about a year.
Very much so.
So yeah, so lots of activity there. And again, looking at the breakdown of which loans they were seeing, again, a huge amount of activity from investor. And Alexis George actually said, we've been kind of almost working on an investor only strategy. So a lot of the products they've been launching, like the IO loan, the 10-year IO loan, and the SMSF one, both focused really heavily on investor. So she's like, this is really where we want to be playing. So I expect to see more products coming out from them this financial year. But of course, not the only bank releasing its results. We had Westpac today release quarterly.
Quarterly.
We've seen PNN release their results, although they're unaudited.
With ANZ as well yesterday.
ANZ quarterly update.
Not a lot on the total portfolio.
The quarterly ones never give us as much information.
No, we've got a bit more from Westpac, but yeah.
Yeah, and then AMP obviously was a full year, so we got a lot of information, and CBA, as always, gives you a lot of information, which we love to be able to pull apart all the data and go through all those slides. So yeah, lots more to come next week as well, with more results coming out, and maybe more announcements from brokerages as well, because we've been hearing a lot from the brokerages recently, including the top 25.
So speaking on that, we did release our top 25 brokerages ranking this week, which will also be out in our February mag as well.
Out now.
Which is out now. But yeah, it's now in 17th year. It's one of our biggest sort of recognition programs that we have at the Advisor. And it's a great way to see the brokerages in Australia that are kind of the top performing. It's partnered by Liberty, who's a really good partner on this. Liberty Financial, yep. But yeah, basically the nuts and bolts of it, the ranking's sort of determined by a number of factors: loan book size, value of loans settled, number of loan settles, years in business, number of active brokers and loan writers, and broker efficiency. And we put all that into a spreadsheet and come out with the winner, or the top ranked brokerage. And the top ranked brokerage for 2020, would it be 2025?
FY25, yeah.
FY25 is Aussie, which took out the top spot. In FY25, Aussies, 1,312 brokers settled over 50,000 loans worth around 28 billion.
Wow.
And the total loan book grew to 85.1 billion as of 30th of June 2025, which is massive. Yeah.
Also this year, so Agile had their hands full because Aussie and Lendy Group changed their strategy where they moved Lendy Group brokers over to Aussie.
Yeah.
So Agile had their hands full trying to figure out how they're accounting for all of this. And they said it was incredibly close between the top three, Aussie, Mortgage Choice and Loan Market, in that order. They said it was honestly near tie-break levels, like so close. So they were like, it's actually getting increasingly hard to really do this ranking because everyone is doing so well. They're really tightly run. Loan Market's obviously a lot smaller in terms of the branded brokers. I think it's around half the size of Mortgage Choice and Aussie, which have over 1,000 brokers each.
Yep.
So they were kind of saying, but interestingly, they have like different stats where they pull them up and then they have different efficiency scores. So they were like, it's really interesting. And I think we'll see broker efficiency continue to increase. It has increased quite a bit in the last few years. And now that all those three brokerages have actually released AI tools for their brokers as well.
Yep.
Last year at all of their conferences, they were talking about using Gemini or AI or having their own built proprietary platforms. I think Aussie's doing a lot in this space in terms of building it. So seeing that, I think, will increase efficiency. So I'd be very keen to see the figures for broker efficiency in FY26 because I think they'll all be radically up. We might even push past the 30 mil mark per broker for the bigger the bigger brokerages, which sounds small when you compare it to the independent ones with only, 10, 15, 20 brokerages. Their broker efficiency scores are much higher. And that's partly, I think, because it's easier to be efficient when you've only got 10 brokers. When you've got 1,000, it's obviously different people working different ways. You might have some part-time brokers in there as well, whereas the smaller ones probably all full-time brokers and they're probably very well resourced.
Go.
Yeah, huge amount of information in there. So do check out the February edition of the magazine if you haven't already. It's online, and if you're a premium subscriber, you would have had it sent to you already in the post. You get to flick through the pages and have a look at whether you're in there. Ben, Charlie, thank you so much for joining me today. Any nice plans for the Valentine's Day weekend?
Well, I've got, in addition to being a writer and a journalist, I'm also a crooner. Although I don't really like that title. I'm
get you singing on here.
But hopefully one day we talked about maybe composing some intros. I think that would be nice.
Yeah.
Sprucing up the mortgage making headlines podcast with a little bit of Nat King Cole style.
Oh, love it!
But I'll be doing a lot of Nat King Cole and Sinatra.
Hard pressed finding lyrics to.
Oh well, you
never
never know. We can amend an existing song.
I mean, we've had a lot of inspiration this week with all those press releases about Valentine's Day. I'm sure we can find something.
We need no reminding that it's Valentine's Day on Saturday. But I've got a big show on Saturday, so that'll be keeping me busy, and then probably just recovering on Sunday. Yeah. So I'm looking forward to it.
That's exciting.
It should be good.
How about you, Ben? Any nice plans?
Not too much at the moment, but we'll see how it all pans out.
Maybe go and watch Charlie sing.
We'll see.
I'm not really doing anything fun this weekend, but next weekend I'm away, so I'll be kind of taking time this weekend just to
prep.
Nice. Exactly. Good. Clean the house, do all the stuff I won't be able to do next weekend. But of course, it's Valentine's Day as well, although I don't tend to do anything for it. Kind of feel like I don't want to sit in a restaurant with loads of other couples and pay it.
I feel a bit strange doing this show because I've never been a big celebrator, so it's going to be a bit of a 0 to 100, but still got to get in the mood.
There we go.
On this afternoon.
Well, best of luck. Best of luck for it.
Thank you very much.
And for everyone else, we hope you have a fantastic Valentine's Day if you celebrate. And if not, well, enjoy the weekend reading the Advisor News. It's all there for you on theadvisor.com.au. Check out the Weekender Bulletin, which will come out tomorrow morning, which is a summary of the top stories of the week. And of course, do take a listen back to previous episodes on the Advisor Podcast Network, including podcasts with some of the top 25 brokerages. Brokers, this week we released a podcast with Colin Mason and Jesse Spencer from top 25 brokerage called Mason Finance Group /InvestBlue. They were in the ranking. We've had one recently with Darren Little, who's in the ranking with Smart Move. We've, as I mentioned, Simplicity. We've done podcasts with them in the past. There's a whole bunch of podcasts out with the top 25 brokers to find out how they're running their businesses. And of course, don't forget to get your ticket for the Better Business Summit, where we'll also be talking to top 25 brokerage leaders about how they've scaled their businesses. Really fascinating to hear how they've done it. And you can hear from Darren Little from Smart Move, which has more than 100 people in their broking arm at Smart Move, about how they built their business. So do make sure you buy your tickets soon if you haven't already, because they will sell out. We'll hope you have a fab weekend, and we'll catch you next time for another episode on the Advisor Podcast Network.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.